Momentum investing has underperformed for 8 straight quarters, but recent data suggests a turnaround has begun. Today, we are unpacking the hard data behind the absolute worst momentum investing slump we've seen in 2 decades and investigating whether a massive turnaround is already underway. If you follow quantitative strategies, you know it's been a really rough ride lately. But you know us, we aren't just going to look at the surface level panic. We're going to dig deep into the empirical data, look at historical precedents, and map out exactly what the numbers are telling us right now. So, is momentum investing dead? Look, I know a lot of retail investors are asking this exact question right now after watching a historically winning quantitative strategy just hemorrhage alpha for 2 agonizing years. And hey, it's a totally fair question. When a strategy built on buying winners and selling losers suddenly just stops winning, it really shakes your confidence, right? Momentum is supposed to ride the wave, but lately it kind of feels like it's been caught in a relentless undertow. Negative 11.3%. Wow. That alarming number is the rolling 2 year alpha of the Nifty 200 Momentum 30 index compared to the Nifty 50, specifically from Q3 2024 to Q2 2026. So, what does that mean in plain English? Basically, over the last 8 quarters, momentum strategies haven't just trailed the broader market, they have drastically underperformed it. For a strategy that literally exists to generate outperformance, that is a deeply, deeply painful metric. And to put that into perspective, this trench we are in, it's historically deep. We are marking the absolute worst rolling 8 quarter performance in our entire 21-year dataset. I mean, it completely bypasses even the brutal post global financial crisis period back in 2009, which bottomed out at negative 9.1%. We are currently sitting in the deepest, longest momentum drawdown in recent history. So, the million-dollar question, is the worst finally over? Well, while that historical drawdown absolutely hurts, let's put on our detective hats for a second and look at the hard data signals, because they're actually suggesting we might be standing at a major inflection point. You see, in quantitative finance, the point of maximum pain is very often the exact point of maximum opportunity. We need to look past the rearview mirror to see if the foundation for a real structural turn is being poured right now. Now, here is where things get really fascinating. Look at how momentum actually behaved defensively during the Q1 2026 market crash. The Nifty 50 took a pretty heavy hit, dropping 11.1%. But the Momentum 30, it only fell 7.8%. Why does that actually matter? Because a healthy momentum factor should naturally do exactly this. It should shed losers faster. Rotating out of dropping assets to act more defensively than the broader market is a classic hallmark of a factor beginning to reassert itself. Building right on top of that defensive strength, we are finally seeing the green shoots of recovery. After a truly brutal stretch, Q1 2026 posted a positive 3.3% alpha, and then Q2 delivered a positive 4.3%. This is huge because it marks the very first back to back positive quarters since 2024. And get this, in all three of the prior negative 8 quarter episodes in our dataset, this exact pattern of 2 consecutive positive quarters was the trigger that preceded a massive multi quarter resurgence. Now, check out this historical fact. In 21 years of data, momentum has literally never had 2 consecutive years of negative alpha exceeding minus 3%. This is vital context because 2025 delivered a crushing negative 13.3% alpha. So, if the 21-year pattern holds true and momentum never stacks 2 deeply negative years back to back, logic powerfully points to 2026 being a massive bounce back year. And we're already seeing this play out, right? We've got a positive 7.5% year to date alpha halfway through 2026. Let's look a little closer at that mean reversion pattern. Every single time momentum has had a really bad year, like the minus 6.7% in 2008 or the minus 14.3% in 2022, it was always followed by a massive surge. I mean, just look at 2022's drop. 2023 saw an immediate 18.8% alpha bounce. Past slumps were always followed by major recoveries, whether immediately in the next year or with just a slight 1 to 2 year lag. Think of it like a coil spring. The more it gets compressed, the harder it releases. And historically, if you bought momentum right at the bottom of an 8 quarter slump, it has delivered a staggering average of 20.7% alpha over the following 12 months. The closest match to our current scenario is 2023, which delivered almost 23% alpha just in the 4 quarters after the bottom. As you can see, those post-trough recovery spikes are absolutely massive. So let's just do the basic math on the opportunity here. Because momentum fell so much further from its peak during the slump, it literally offers about 2.5 times the absolute upside compared to the Nifty just to get back to its previous all-time highs. The Nifty only needs about 9% to reach its peak, but momentum? It needs nearly 23%. If you are looking for absolute return potential in a market recovery phase, the asymmetry here is undeniably compelling. Okay, moving on to the FII risk factor. To keep things completely objective here, we absolutely have to address the elephant in the room and look at the primary risk that could delay this whole thesis. So, what are the red flags? Well, the primary driver of all that initial underperformance was sustained liquidations from foreign institutional investors, or FIIs. In April 2026 alone, we saw over 40,000 crores in net negative FII flows. When foreign institutions start selling, they tend to target those highly liquid, high PE quality and momentum stocks first. Plus, when you add in geopolitical tail risks, like US Iran tensions potentially messing with crude oil, you get external shocks that can hit momentum names way harder than defensive ones. Basically, a true structural turn requires FII stabilization to act as the confirming trigger. Next up, the Wright factor fund, navigating the turn. Understanding the raw data is one thing, but how does this actually play out for an investor trying to capture the upside? Take a look at this real world application. Early in the year, the Wright factor fund was actually tracking slightly below its benchmark, the BSE 500. But then it experienced this incredibly sharp definitive recovery starting in April 2026, which not coincidentally is exactly when our momentum data started flashing those positive green shoots we just talked about. The fund quickly caught that inflection point, and remarkably, over the 3-month period, it actually delivered positive returns while the benchmarks on negative returns. It's consistently outperforming across the 1 month, 3 month, 1 year, and since inception time periods. Alright, let's bring it all together. The historical base rate points to a massive recovery. The technical structures, like that defensive drawdown we saw in those back-to-back positive quarters, strongly suggest we might be staring at the best momentum entry point since 2023. Sure, FII flows remain a critical watch point, but the sheer asymmetry of the upside potential is incredibly hard to ignore right now. So I leave you with this one vital question to ponder. If the spring is compressed to historic levels and the data says the snapback has already begun, are you positioned for the turn